Welcome to Lesson 1. Thank you for purchasing the Cryptonary course, and congratulations for investing in not only yourself, but the future of money. Before anything, who am I? And why am I the one doing this? I am doing this because cryptocurrencies changed my life. I went from working 16-hour days in a corporate job, living an average life with barely average money in my savings account, to stumbling across the market in 2013 at 3 AM during a night shift. The deeper I researched, the more I was led to stories of people making 6 to 7 figures, or suddenly seeing their investments explode 4,000%. I was hooked. I spent over 3 years studying the cryptocurrency market from this point, and over the ups and downs of this period, I turned my life savings of $10,000 into a substantial sum of money. Not quite $1 million, but $2.9 million. I'll even be showing you many of my accounts throughout the course, including transaction history, deposits and withdrawals. Before the great times did come, I suffered every mistake a crypto investor faces, losing most of my life savings, trying to take old habits from the stock market and other market into cryptocurrencies, not realizing that cryptocurrencies require a whole new mindset and set of skills. In the past 9 months alone, I've helped family, friends, and over 250 people understand the crypto market and begin seeing profits. This course was made so you experience the same successful route as myself without suffering the failures and losses I did to get here. So now that you know a little about Cryptonary, let's go to lesson 2. So, let me guess how you found cryptocurrencies. Your friends have bought some. You even heard a few people became millionaires overnight. And now they're telling you that you have to get in now because the coin they hold is going to $1,000 soon, and they hold 400 of them. Sound familiar? Well, don't worry. Grab yourself a pen, grab a good sized notepad, and why not grab a cup of coffee? Because over the next 5 chapters, starting from this very video and the following lessons, you're going to be receiving a lot of information that you will definitely want to be noting down along the way. Enough to fill the notepad you're holding, in fact. I've made this even easier to achieve. Notice the little camera icon in the corner? Well, every time you see that, I want you to pause the video and note down everything you see. Whether you understand it or not, this will benefit you moving forward. So now you're all set, I think it's time you know exactly what a cryptocurrency is, what its uses are, and why you would want to own some. And to do that, we have to dissect it into its simplest form. So let's take the word cryptocurrency and split that into 2 pieces. We start with crypto, meaning concealed, secret, or hidden. The term is usually placed before a word to refer to something or someone with hidden principles. Then we have currency, usually a form of money, acceptance, or commodity. Merging these 2 words back together, cryptocurrencies are an anonymous form of digital asset class, generally accepted as a form of currency, payment, or means of value, usually secretive in its method of delivery, or at least concealed to some extent. Some other essential facts to know are: a cryptocurrency cannot be counterfeited due to the use of cryptography for security. There is a limited quantity of each crypto out there, meaning the entire quantity has already been created through a process called mining, or they will eventually reach the final amount created at a predetermined time in the future, meaning technically every time a new coin is created, the supply decreases and the demand increases as we reach closer to no coins being left to generate. Finally, there is no debt with cryptocurrencies. It is the same as owning physical gold. The crypto you own is real and the actual thing, unlike the numbers in your bank account, which are created without the actual asset needing to back it up. But before that, what many do not know is that cryptocurrencies have been in existence since around 2008, when the present day's market leader was invented. You guessed it, Bitcoin. Bitcoin was the first virtual currency of its kind, formed from the many failed attempts at a centralized digital coin. Its creator Satoshi, who to this day remains anonymous, found that by handling all transactions sent between peers on a network called the blockchain, verified by miners which we stated earlier, a decentralized network is formed from this, meaning no third party such as a bank or government can interfere. So cryptocurrencies have one real purpose, and that's to remain a method of payment which we as the people control and confirm, without the banks and governments interfering on our daily transactions. Keep this in mind, as it will help with breaking down the blockchain in the next lesson. So in this lesson, we're going to be covering correlations. Now, just like Forex and stocks, there are certain pairs that correlate. However, in cryptocurrency, there is no longer correlation. Only a month ago, we've actually just broken away from the correlation of Bitcoin, where Bitcoin controlled the entire market. This meant if Bitcoin rose, the rest of the altcoins would rise with it. When Bitcoin fell, everything else would suffer alongside Bitcoin. However, in the past month, a very interesting shift has taken place, where now every coin is doing its own movement. This means they're independent now, and all analysis can be done on a case-by-case basis for each crypto. So whereas before, you would be analyzing, for example, Ethereum, but then Bitcoin would completely crash due to whatever news or circumstance, your analysis on Ethereum would be completely wiped out and incorrect, even if it was respecting for weeks on weeks on weeks. So we are at quite a good time right now, where we're eventually breaking away from the Bitcoin correlation and also the reliability of Bitcoin. This allows a lot more coins to become independent and actually exceed their potential. So the problem was a lot of coins and cryptos and tokens, they were reaching certain plateaus where we would hit a certain price level, but then we could not reach further because Bitcoin would not go further itself. And if we look today on the coin cap of all the coins, ideally we're going to analyze up to Neo just to cover the main. You can see that Bitcoin has jumped 9.32%. Since breaking the barrier of $5,000, it's almost jumped $700 in almost a day. That is absolutely insane. And as we can see, the market cap has completely soared to almost 94 billion. So what we're going to do, we're now going to look at the rest of these. And if you can see, Ethereum has jumped 7.4% today. So again, it's a great increase and actually quite a huge increase. But what we're noticing is there are pairs like Ripple, which is down 4.71% today. Bitcoin Cash, which does not even correlate with Bitcoin itself at all. Litecoin is actually one of the clear winners today, jumping 10.63%. Dash, not doing too good, but still up 2.32%. Now remember, this is crypto, so 2.32% is fairly average. NEM, down 4.5%. Neo, down 3.35%. So what you can see is overall, it's almost a pattern. Two of the top coins are up, the bottom two below are down, the other two are up, the bottom two are down again. And in fact, this is a correlation that seems to be fitting for the top 10. So if we go from Monero onwards, you can actually see a pattern forming here. So what I'm trying to get across here is there's always an inverse correlation or a strange correlation of some kind, but it's never logical. So as you can see here, 2 up, 2 down, 2 up, 2 down, 2 up. So when we move to the chart, we can see Bitcoin absolutely flying today, almost reaching $6,000, now slightly pulling back, a huge gain. You move over to XRP and things are not looking the same. Bitcoin had its initial surge and now it's been crashing for the past few days. We have Ether today. Ether has been gradually rising before exploding today to $330 compared to Bitcoin's explosion, which has been a straight upwards movement. And then we move to Litecoin. We're seeing a jump. We've been consolidating. So whilst other pairs have been going down, have been going up, we've been consolidating during this same period, only exploding the prior day, now retesting support, so we are looking to explode further on Litecoin in the upcoming days. Moving over to BCH. Now BCH has been having a catastrophic fall for days and days and days. In fact, this is probably 3 months worth of just crashing. So it isn't looking too good for Bitcoin Cash, which again you would expect to correlate with Bitcoin. When we move to Dash, Dash has been going up. It's had a huge fall down, but overall we have been falling and we are slowly rolling over again. When we move to NEM, NEM has been in a straight up consolidation. Although it looks like we have been falling, which we have, overall we've been restricted within the same boundaries. So there's been no real movement from NEM. Whereas Bitcoin again has just been flying during the same time period. We finally move over to NEO. And looking at NEO, we've had a huge rise, a huge crash. We've gone up, but we are still stuck within the same zone. We have not really made any further highs. We haven't made any newer lows. We're stuck in a constricted boundary. So what I really want you guys to take away from this is we're now at an amazing opportunity in the cryptocurrency market, where you no longer need to rely on Bitcoin or analyze Bitcoin to determine where your coin will go in the future. This now means, as you can see from my charts, all analysis is completely individual to each cryptocurrency, and every single turnout could be completely different in the upcoming days. So just take this into account, really study the charts on this, have a few up at the same time, have a look, monitor on a daily basis, take a week's worth of data. If you thought the blockchain basics were interesting, wait until you discover mining. Best compared to the mining of real gold. For the sake of you understanding this easier, we'll stick with Bitcoin for this example. You should have taken note of Bitcoin having no central authority, meaning there is no centralized location that can distribute or create it. The peer-to-peer network means every single one of us that uses Bitcoin, for whatever reason that may be, is technically part of the bank of Bitcoin. So you may be asking, who exactly does create Bitcoins? Well, quite simply, miners. With no higher power controlling the blockchain and its network, we, the people, have to manage this ourselves to keep the blockchain alive, and as natural human tendencies go, we usually don't like doing work without a reward. So Bitcoin creator Satoshi developed a system based upon mathematical algorithms, just like a video game, and the cryptography, where every time someone solves the algorithm using special mining software, they are rewarded a certain amount of Bitcoin. The Bitcoin network automatically increases the difficulty of these equations and the Bitcoin reward amount as the levels progress higher. These levels, so to speak, are called blocks. Yes, the same block used in the word blockchain. Each block has a capacity of around 1 megabyte, so every transaction or activity on the network gets verified by miners until this 1 megabyte limit has been reached, and then we move on to the next block, forming an enormous chain of blocks filled with lots of data inside each one. You see what I'm getting to, right? Blockchain, a chain of blocks. This gives more people the incentive to join in and help run the network in hopes they receive Bitcoin in return for their work. As the levels get harder, so does the computing power, however, which means nowadays it's hard to mine Bitcoin without having several hundred gaming graphic cards running at the same time. In simple terms, Bitcoin miners are processing transactions and securing the network using specialized hardware, and in return, they're collecting Bitcoins for completing these services. This is essentially what blockchain is all about. Decentralization means everything that happens is being verified and stamped permanently into whatever block it was verified on, meaning the information can never be removed, which is what makes blockchain so great, as it greatly removes the risk of fraud or illegal activity, especially once big corporations begin using it. You may have noticed a little camera was present throughout all of this video. That's because not a single second should have been missed. This will help you greatly moving on to the next lesson, where we begin to uncover the life and history of Bitcoin and how we can take this knowledge and begin to profit greatly from it. See you in the next lesson. A word you would have heard over the span of 2017, maybe more times than you would have liked to, is hard fork. Mostly closely associated with the Bitcoin's endless hard forks shaking up the market, Many know it provides so-called free coins, but not many know the purpose and actual steps for this hard fork to take place. To start off with helping you understand, a hard fork is no different to a software update you would get on your phone or computer. It just has to go through a much longer route to activate the upgrade compared to just pressing the upgrade button. This is because it takes more than one party to make this change. So firstly, why is a hard fork needed? It can be for a multitude of reasons, such as the memory size of each block, for example 1 megabyte, is no longer sustainable as the blockchain grows in popularity and size, so it needs increasing. Or a crucial security flaw was found in the original blockchain code. Maybe the blockchain just needs some new functions like an iPhone software update. Or in the worst case, a large amount of funds may have been stolen from a wallet. Now, this doesn't necessarily mean it's always for the greater good, as it has been suspiciously coincidental that occasionally a decision to fork is made for seemingly the smallest of reasons, and in reality the miners just want the free coins that are instantly mined from this process, to then dump on the market for a huge profit. So, let's say one of these situations arises. What happens now? Well, as you know from the previous lesson, the blockchain is ran and verified by miners, mostly miners running on an extremely large scale, in factory-sized locations full of graphics cards, working away at these algorithms all day. Essentially, it is these largest players that control the price of the market and how the blockchain runs. To upgrade and create a fork, these miners have to switch from mining and verifying the old blockchain to updating the mining protocol, aka the software they use to mine, and begin mining the new blockchain instead. The switch from upgrading the protocol and mining the new blockchain creates a split from the old original chain. This means all transactions become invalidated if they're being performed by someone still on the old blockchain, as those still running previous protocols will be left validating the old chain. This creates a permanent divergence where those running the previous blockchain can upgrade should they wish, but the new blockchain miners cannot downgrade. So a choice is made to continue verifying the outdated chain or join the new chain. The graphic pictured shows this process in its simplest form. The blocks on top are the original blockchain. The blocks on the bottom are the day of the fork. A new upgraded blockchain is formed, starting from a new block 1. The old blockchain also continues. An example of this is Ethereum Classic, where one of the largest hacks and theft in crypto took place, and the founders decided a split was needed to reclaim this payment, and then continue mining the new blockchain from that point onwards, with its upgraded security measures. This is how Ethereum was born. Many did not agree with this and decided to continue mining the classic blockchain as it stayed true to decentralized, not going back on its principles. As you can imagine, it's not as easy as every huge mining powerhouse getting along, agreeing, and all joining the same protocol. This is handled by a vote and a predetermined date when the fork will take place. The vote is public and allows us retail investors to observe this and see how many favour one chain more than the other. They are also not obliged to tell the truth and can very easily vote for the opposite choice to manipulate the market on the day. When the date comes and the system upgrades itself automatically, it's up to the miners to take the steps just before to be prepared for this and adapt to the new protocol. During periods of hard forks taking place, always be extra cautious if it's related to the cryptos you hold. I do not personally recommend trying to time the market and trading the newly mined crypto for a quick profit. It has not ended well for a lot of people. This can bring great investment opportunities, however, as the crypto that is expected to fork will usually have a huge price growth during the run up to the split, as investors buy as much as they can to receive the free crypto from the fork. But this also means the day after the fork, the price can get very volatile to the downside. So you've heard of hard forks, but have you heard of soft forks? Not much different from the previous lesson. The underlying principles and goals of a soft fork remain the same as a hard fork. The software protocol needs to be upgraded, but the key factor that separates the two is that a soft fork is backwards compatible, and doesn't need to split. So, the process is a lot less impactful on both the community and the crypto's value, meaning upgrades to the protocol are technically never upgrades, but more of an alteration to the original software, where a hard fork can actually upgrade the size of each block from say 1 megabyte to 2 megabyte. A soft fork has the ability to implement a change similar. However, instead of upgrading, you can actually reduce the block from 1 megabyte to 500 kilobytes. In the blockchain and mining lesson, we covered nodes. To recap, a node is defined as anybody who possesses a copy of the blockchain and runs it on their computer. These are the people who also help validate the blocks. They play a crucial role in forks, as it is up to the nodes to reach an agreed bias and start validating the upgraded blocks by a specific block number. Otherwise, the fork will fail and validating will continue as normal on the original chain, whilst the upgraded chain simply falls off and becomes unusable. Imagine it this way: the blockchain has currently reached block number 3655. They have decided from block number 3657 the majority of nodes must be upgraded and mining blocks with the new upgraded protocol if they wish for the fork to be implemented. Nodes can upgrade in advance and start mining under the new protocol. So if we reach block number 3657 where the fork is planned to be implemented, but only 20% of nodes have upgraded, the chain will fail and go back to the original. If, however, over 80% choose to upgrade, then the fork becomes a success, and anybody mining the old chain will be wasting time and money, as they will not receive rewards anymore for validating the old chain. When the soft fork is activated to define new rules, the blockchain only temporarily splits, whilst the new rules begin to be implemented. This makes soft forks slightly more ethical in how they go about initiating the decision. Instead of causing a divide in the market, everybody comes to a mutual agreement and then go about the new change together. When starting off in cryptocurrency investing, it can be quite an obstacle trying to adapt coming from an already existing financial market background, such as the stock market or forex market. Even if you have not come from already trading another market, many of us have pre-assumptions of how markets work through the media, word of mouth and the internet. All three have their differences, but cryptocurrencies are a lot closer related to the absolute basics of the stock market compared to the forex market, where the difference is a bit more obvious. Let's start with forex, also known as FX. FX trading is predominantly margin based, which means you never really own the currencies you buy. You're technically borrowing money to increase your buying power and control a much larger position than your account size would allow. This means the capital in your account is used as a deposit and guarantee should your leveraged position go against you and it needs to be liquidated. When you actually place a trade in Forex for a currency pair like GBP USD, the pound versus dollar, you are never actually buying the physical currencies. You are essentially betting on the outcome of the currency going either up or down. You do not have to worry about storing currency or signing any contracts. You just speculate on its movement from the comfort of your online platform or phone. FX volatility usually stays well below 1% on any given day, except for news events. The market trades over $5 trillion a day and is extremely liquid. Prices measured in increments called pips. Buy and sell orders are almost instant. Price moves mostly from technical analysis and usually is completely logical in respect to these levels, unless a surprise news announcement happens. Now let's compare crypto and stocks, as they're slightly similar to each other and we can identify the differences as we go on. Whilst the ability to margin trade both stocks and crypto is possible, this is more optional and only in specific cases. This means you can only buy what your current account balance can afford. Margin trading crypto in particular is a one-way ticket to going broke. The market is still too young to have the liquidity like the FX market, meaning if price spikes against you, there may not be a buyer available to clear your sell order, leaving your trade to continue running in further loss, with money you do not have in your account. When you invest in the stock market, For example, in Apple, and let's say in this scenario, Apple's trading price is $50. This means the price for one share in Apple is $50. So price moves in a more recognizable format compared to FX and just sticks by moving up or down in dollars, euros or pounds. In crypto, if the price of a coin is $50, this means to buy one coin it will cost you, just like stocks, $50. If you wanted 7 shares of Apple, it would cost you $350, as you're buying 7 of the shares worth $50 each. Vice versa, 7 cryptos worth $50 each would cost exactly the same. Unlike FX, investing into shares of a company means you actually own a piece of that business now, and technically as a shareholder in the company. This is usually represented in the form of a printed certificate after investing, whilst buying crypto from an actual exchange means you genuinely own those coins. Seeing as these are digital currencies, you cannot own them physically, only in their true digital form. However, this also brings the responsibility of protecting and securing these coins online as if they're currency in physical form. Technical analysis also works with stocks to some extent. However, the real shifter of price is news announcements on quarterly or annual reports for the specific business you have invested in. Cryptocurrencies work on a combination of the two. Technical analysis can work very accurately once you know how to use it for specifically cryptocurrencies, as FX technical analysis is not valid with crypto charts. Technicals alone can cause price breakouts of 50% and beyond. Yet due to the market being so young and unregulated, news announcements are also used as manipulation days for the players in the market with large volumes of crypto that can shift the price up or down. One last difference with crypto compared to other markets is the volatility is so frequent that it's actually much more effective to hold during large falls in price, rather than alter your entire investment bias like you would do in Forex. It's going to be very different to what you're used to, and it may seem scary at times. That's what I'm here for, guiding you every step of the way. See you in the next lesson. So, a topic that has been brought up frequently in the cryptocurrency world, and that is Bitcoin and gold. What is the correlation? Is it a good hold of wealth? Can it store value? Is it a good long-term hold of wealth? Can it protect you against financial crashes? We don't really know yet. And that is because we're going from 2 different time zones. We can see here, gold itself, looking at the chart, has been an incredible store of value since around 2001, up to around 2011. However, from 2011 to 2016, it's been a catastrophic fall. Although in the longer term, and I can imagine in 10-20 years time, this will be absolutely minimal, we cannot take and choose between two. So if we go back previously, it has over the years, since the chart started in 1971, we have of course gone from practically zero to around an overall high of $2,000. Now looking at Bitcoin, we've already exceeded this almost triple. In fact, we have just hit triple today. So we're looking at 2 different time zones here, whereas Bitcoin has done this in roughly 6-7 years. It's taken gold a much longer time. So we're going with 2 completely different investment criteria. And in my opinion, whilst Bitcoin may get you there faster, it does not necessarily mean it will sustain there for the longer period. Now, the way I see this is, Bitcoin is essentially digital gold. There's no doubt about it. However, this is because Bitcoin is the only real alternative to gold we have that is digital. So for the time being, it's the only option we have to actually invest in. However, we have to understand the gain has happened so fast. And although there is limited amount of Bitcoins, just like there's a limited amount of gold, we will eventually reach our limit on how much we can mine. So this may drive the value up over the short term, but this does not necessarily mean the value will sustain over 10 years, 20 years or 30 years. And the truth is, even if it does, we do not know right now. And that is because we've only been around since, in this chart, 2012. And again, if you go to the XAU USD pair, just like Bitcoin, we've started since 1971. So we have a much longer term outlook on this. So we can see no matter what has happened, gold, physical gold, has sustained through all kinds of financial and market crashes. So for me personally, if I needed a store of value, I would continue to put my money in gold, especially as a hedge against currency crashes, market crashes. There could be scandals. Gold will usually sustain during these events and incidents. With Bitcoin, however, that would be my alternative to a bank account as an example, and a quick turn gain. If I wanted my money to be safe over the next 5-10 years and also grow substantially in value, then I would definitely be putting my money in Bitcoin. However, we cannot get mixed up with the fact this is not real gold. And do not get me wrong, I do believe the fundamental assets are there for it to become an extremely worthwhile investment. But for the longer term and securing your wealth, Bitcoin is extremely volatile. I mean, as you can see already, jumps like this from almost $2,000 to $6,000. We went from June to October. That was all it took to jump $4,000. Now we go to gold, and you can see a jump of that equivalent has not even happened yet over the span of decades and decades, and we have not even achieved a breach of $2,000. So you can see where the sustainability and the actual security of gold comes in terms of long-term asset security. So with Bitcoin, go back one more time, just from the daily chart, we look at the swings and we can see a nice steady increase over time. And again, that's only because we've barely been around long enough to see what will really happen. Due to the nature of this currency market, cryptocurrencies can easily be replaced in 5-10 years by a better crypto. We're at that current time where there's a lot of new contenders coming forward, and Bitcoin's usability, especially as a currency, is not sustaining. Therefore, we're having hard fork after hard fork, and other coins are coming up with better use cases, faster payments, lower transaction fees. So right now we're at the guessing stage. All it takes is one competitive coin to actually be adopted by the mainstream, and Bitcoin's real value will slowly be diminished. And just because it's the main contender now and the leader, and especially because it has the largest market cap, it does not mean in a decade's time it will be worth the same as it is now, whereas another coin may be worth 10,000, or gold may increase to the similar value. For all we know, they could also correlate together. But for the time being, do not see this as a way of securing a digital gold. Just see this like a regular cryptocurrency investment, a long-term investment for that matter. However, when it's rising as fast as it is now, do expect reverses and crashes in the same percentage. Therefore, I'm talking 30% to 70% crashes are extremely likely. We've seen Bitcoin fall from highs of 3,000 before. We've seen it fall from 2,000. We're now roughly and potentially going to see it fall from 7,000 back to 5,000. Falls in value of several thousand% or several $1,000s is not sustainable over the long term and is very volatile, and this will not be adopted especially by the older generation or longer term investors, as it is a very volatile asset to have in a portfolio. So guys, just take this into consideration. Always do your research when trying to go down the route of finding a long-term investment. But overall, they're both great for long term. However, to store your value, I would potentially stick with gold. If you want to make some great money, Bitcoin. That's all for this lesson, guys. Thank you. So in this short and simple lesson, we're going to be covering altcoins. You may have heard this term be sprung around all over social media, forums, and the internet. And that's because altcoins are essentially every single cryptocurrency circulating in the market besides Bitcoin. Now, the same way we broke down cryptocurrency in a previous lesson, altcoin can be broken down into two words also, with alt being an abbreviation for alternative, and coin, of course, being an abbreviation for currency. So essentially, it's an alternative cryptocurrency, which is every single currency in the market besides Bitcoin. Now, what has happened is, since the creation of Bitcoin, essentially all of these digital currency companies and organizations have begun to spring up. And their main goal, essentially, is to either become a mainstream adopted company with a real life use case and get the whole world eventually using cryptocurrencies, or they have one ulterior motive, which for many coins is just to overtake Bitcoin and become the next first place contender and staple for cryptocurrency payments. So what you're seeing right now is the largest growth in the world of cryptocurrencies right now. So what you see here is Bitcoin. Bitcoin is number one. Bitcoin has a market cap of 97 billion. And its closest contender right now is Ethereum. But if we start scrolling down, we'll get back to those later, you can see the largest amount of growth the world has ever seen in investments available. We keep scrolling. What you can see here is 1,185 cryptocurrencies in existence right now. And the problem is, guys, you may see this a lot especially on the Cryptonary Instagram. I constantly tell people, avoid the junk coins. Stop paying attention to coins just because they have a tiny price. Just because they're worth 0.001045. This does not mean they're worthy investments. And we're stuck in a current bubble in the cryptocurrency market. Not essentially a bubble which is going to explode, but we're stuck in a bubble where new investors are being sucked in. People with no investment knowledge whatsoever, in particular for cryptocurrencies, are starting to get recommended and tips. And they're starting to look at all of these coins are literally worth 0.0000000. You get the point. So what's happening is they're going in, putting down just a small amount of money, or potentially even thousands, in hopes that one day these coins are going to explode in value. But the problem is, you may have noticed, these coins are surging hundreds of percent in a day. Now this seems attractive, I get that. But what people are failing to realize is there's only a small few who are actually controlling these cryptos. And the reason is the market cap is tiny. So you're potentially having 50 to 100 people who have multi-millions in dollars who are pumping these coins up to ridiculous prices, hundreds of percent in a day. The minute they're happy, they short these cryptos and they wipe out every single investor on the way, tripling and quadrupling their original profits. Once that's done, they move on to the next coin. Now what you have to understand is alternative cryptocurrencies means they have to have some kind of alternative use. And the truth is these coins do not have a use, guys. And a lot of them are made purely to pump and dump. We have Ganja coin. We even have President John coin. We have Swap coin, Strong Hands. And you can clearly see these coins, they have no use in society. They're just being used to pump and dump. So what I actually recommend for many new investors is, first of all, do not listen to people who are preaching these coins to you. They have no use case. Do not listen to people that keep telling you about ICOs. We cover that later anyway. The point is, you want to actually succeed as an investor, and longevity is key in this market. The last thing you want is putting all of your investments into these coins worth minimal cents, and then they just disappear forever. You want to put the odds in your favor, and to do that we have to be smart. And first of all, by being smart, I actually mean just being lazy. No one has the time to go through every single crypto available in existence, even up to the first 100. For new people especially, keep your investments safe. Once you have a nice substantial amount invested in the top 20 in particular, then start moving down and looking at the 20s, the 40s and the 50s. Never, in my opinion, go beyond the 100 unless you have a very good valid reason and have put in the research yourself. And that also brings me onto the topic of, do not invest in any of these cryptos past the top 100 without doing your research. Look into them and look into the use of the crypto. The top 10 in particular, they have use cases, they have business models, they have backing from the governments, they have backing from banks, mainstream large organizations, and this puts them in the front line for future adoption. And all of their cryptos have use cases besides Bitcoin Cash and Ethereum Classic, as these are deviations from the original. Besides them, all of these cryptos have a relevance with the company's business model, whereas the top 100, whereas anything beyond the hundreds, the 500s, and even in the 1,000 regions, they're simply cryptos for speculation purposes. So what will happen is the top 10, when they excel, the crypto will excel with them. The top 50, the crypto will excel with the company as the company grows and starts to become used in everyday life. Whereas the other cryptos which have no use case, the company may grow, but the crypto has no use. So as the company excels, the crypto collapses. You're left with a useless investment. So guys, in general, just please pay attention, keep it simple, do not overdo things for yourself. Stay in the top 50, stay in the top 100, even better, keep it in the top 20. Get the most popular investments. It doesn't matter if they've gone up in price or they're over $100. In 20 years' time, the price will most likely excel these levels, and it makes sense to be invested in the ones that are in the front row to achieve this. So the moral of this lesson, short and sweet, be smart, keep it simple, and invest in the real coins in the top 20.